Welcome to Real Estate Secrets Unlocked, the podcast that takes you inside the minds of the industry's top professionals, revealing their top secrets to success. I'm your host, Danielle Damianov. Whether you're a seasoned pro or just starting out, get ready to learn the latest trends, strategies, and secrets that will help you succeed. Join us as we go beyond the basics and explore what it takes to make it in the world of real estate. So buckle up and get ready for a wild ride. This is Real Estate Secrets Unlocked. Hey everybody, it's Danielle Damianov, and I'm so excited to be here today with Byron and Krissy Wolfe with CFOAF. I have to say, I love the name of your business. Thank you so much for being on, guys. And I'll let let everybody know what your title is, but I think this is going to be a really, really amazing podcast for real estate agents and trying to determine, how to run their business like a business. So why don't you just introduce yourself real quick and let them know what your company does.
I'm Krissy Wolfe. I'm the co-founder of CFOAF. Byron and I have been in business together since 2008. And currently we're helping small businesses grow their revenue and their profitability, and also help them with tax planning strategies so that they are not overspending on their taxes and can put more back into their business to help ensure it grows properly. And it's my husband, Byron.
Yeah, no, she said it. We're co-founders of CFOAF, a tax and accounting advisory firm. I am a CPA by trade, by letter designation. We are both crypto tax certified. We've dealt with all companies from construction to DAOs, which is a crypto thing. We dealt with a lot of real estate agents, real estate companies, real estate investors. So we're really excited to talk a little bit about this. So there may be some things that we're going to talk about that are super basic and people are like, I already know that. But we're also going to talk about some higher level strategies that I think even the people that are not super familiar with the lower level things can benefit from. And those that have been doing this for a long time, hopefully we tell you something that could be really helpful for you as you grow your business.
That's awesome. So now you're nationwide, you do this nationwide, and are you doing actual taxes or basically just tax strategies?
We do both. And so we don't do taxes for people unless we do their strategies. So we do the full process for them. So we do a deep dive interview and an analysis of their financials to determine what strategies are actually best for them. And then we meet with them quarterly to make sure that they're staying on track and they're implementing the things. Nobody can implement everything at once. So what we want to do is make sure that we're kind of trickling everything in until things become second nature for our clients, and then we'll file their taxes. So we want to make sure that we're providing the full service from beginning to end.
Yeah, that's great. And I think right now, with August being, a little, normally, at least where we are, it's a little bit slower of a month. And it's good to kind of start to put these things in place to be ready for tax season, next year. So this, my audience is basically real estate agents, real estate investors, and things like that. And what I have found is that there's a lot of real estate agents. I want to say probably 90% of the real estate agents, they get their real estate license, they sign up with a company, and then they never treat it like an actual business. Yet they're 1099. There's so many write-offs available to them. And so let's talk a little bit. Most realtors are basically filing Schedule C on their tax returns. So what is the difference of filing as a Schedule C, filing as a PA, or maybe filing as an LLC?
Yeah, do you want me to take this one?
Yeah.
All right. So as a PA, you're going to lose some of those exceptions that you're going to have. So you're going to take on a little bit more liability in the LLC category. So as everybody knows, PA is kind of your professional. There's also LLPs, which is limited liability partnerships, which are going to be a little bit more closely associated. That involves multiple people, and you've excluded some of that liability, but you still have a little bit in the LLP with kind of the person that's ultimately responsible, and then those partners that are not. The LLC is the one that's going to provide the most liability protection. So I would highly encourage anybody that's in this space to go ahead and make the move to an LLC, even if the PA is a little bit easier, maybe it fits your guideline. Because with the LLC, now we've changed our mindset to I am a business and not, hey, I'm a professional that's doing this. I want you to be a professional, but I want you for tax purposes to treat your business like a business. So, and we all know this, as you expand out, you want people to come to your agency or your team. You don't want to have to take on all of the work of everything. So if you've created an environment around, Sarah, B. Mosier, for example's real estate, right? Well, everybody wants to talk to Sarah. But if it's Mosier real estate, then they know that they're going to talk to possibly the team. Maybe they want to talk to Sarah or another Mosier, but we've created that business environment. So for me, I'm a huge fan of going to the LLC for that purpose. And it also makes it a lot easier as you expand out, because most real estate agents, you guys get first crack at good properties. And so as you expand out, you are probably going to find things that you want to invest in. And so having that LLC structure already in place allows you to add the LLC for some of these rental properties, your buy and flips, any of those. You've got that that separation of the liability already in place. You're already going down that path. So what I tell all of our clients, all of the people we work with, real estate and everything else, is we want to think big at the beginning, because that's where we're going. We don't want to limit ourselves.
Exactly. And actually,
just to ask you this, you can be a single member LLC. So you don't have to have a team in order to be an LLC or treat your business like a business.
No, you could be a single member LLC, operate as a single member, and still have the Mosier agency, or whatever your name is, or whatever you want to call it. You call it whatever you want. So
yeah, that's a great point. So can you be a single member LLP?
You cannot be a single member LLP because it implies the partnership aspect.
Okay.
So you would need, now a lot of times an LLP will be created with one main person that does it. Maybe it is a professional, say a dentist or a doctor, something. And then there are the limited partners that are investing, or maybe they're handling some of the back end stuff, but they're not the person out front. And so that's when the LLP would get in. Like if you're not a CPA or an accountant, a doctor, chiropractor, dentist, things of these nature, those are really where the LLP would come into place. For a real estate agent, I would highly suggest the LLC. And then ultimately, when you are paying yourself as a W-2 employee, if you decide to do that at some point, that's when I think it's a great move to the S Corp, which allows you to save some taxes on your personal taxes within that LLC that's taxed as an S Corp.
Okay. So you had just brought up a point that I want to, because if I don't say it now, I'm going to forget about it later. Okay. You had mentioned, real estate investing and stuff like that in the LLC, which is great. Some people will form an LLC and only put maybe 4 properties in the LLC. And then when they want to buy more, they're going to do another 4. Is that something you recommend? How many properties per LLC do you recommend?
So I recommend always starting with a series LLC. So a series LLC allows you to have multiple LLCs underneath it. Oh, so wow. Consider it kind of like your umbrella of all the properties you're going to own. Remember, we're thinking bigger, not smaller. And so when we set up that series LLC, every property we buy has its own LLC my opinion is we name it the address. It's just much easier to keep track of, but we have that address. So it's 116 Main Street. And then maybe we buy one that's a street over and it's 311 Elk, Drive. But each one of those has its own LLC. So the liability stays within it and all of our expenses are within that. And those are owned by the one series LLC that's going to hold all those. So going further than that, you may want to start looking into a trust. Let the trust own a holding company. The holding company owns the series LLC, and all of your properties fall underneath it. That's a great way to move into the REIT, the real estate investment trust, which is another great tax strategy when you own multiple properties.
So are you talking about a land trust or a different type of trust?
So a land trust is great. The land trust is generally for like development and other things that come into play. And I hope that all of our real estate professionals that are on the call, end up in some kind of land development, and that's the way that they go, and they're going to start doing these development properties. In the beginning, when you're buying maybe a property or maybe two or three, if you start with the series LLC and you have those all in their own LLC, we can move those into that trust if we want to do that. But I'm specifically talking about ownership of multiple properties. So like your multifam is just going to be one LLC because we want that in there. But if you own multiple houses, even if they're on the same block, we prefer to have those in their own separate LLCs. Unless, this is the one distinction I will say, if you bought 4 houses and your intention is to mass those 4 houses together and sell those as a block to say like a real estate investor or something, then I would say, yeah, go ahead and put them in one LLC, because you can sell that LLC as an asset sale or an equity sale to that investor, and they're going to have some tax benefits as well for themselves there.
Okay. So awesome. So going back to like the single real estate agent, what are some of the tax benefits that would be available to them if they were an LLC or LLP that would not be available to them as a Schedule C?
Yeah. So you can hop on this one?
Yes.
All right.
You're the CPA.
I'm the
Here to
tech guy.
support you.
So we want to make sure that you are a real estate professional. And so probably a lot of your audience members, they already know this, they know the rules. I just want to cover this because this is where I'm going to take it to the simplistic, so everybody knows where we're going. So a real estate professional for IRS purposes is different than a real estate professional from like what you actually do, who pays your check, whatever you want to call it, right? So we want to make sure that we're a real estate professional, and that means at least 750 hours, in an annual period, that we are specifically doing real estate, materially participating in that real estate, or it has to be at least 1 hour more. If you have a side hustle, you have a full-time job, part-time job, whatever, it has to be at least 1 hour more than whatever that is. So that's another piece that people get tripped up on. They say, well, I did my 750 hours. Well, if you worked 1,200 hours, somewhere part-time, then you have to do 1,201 hours in real estate, to be a real estate professional. And so once you have that designation as a real estate professional for tax purposes, all of those passives become active, ordinary, whatever you want to do. So all the things that you're doing, they're taxed very differently depending on what bucket they fall into. So there's ordinary income, your earned versus unearned, your passive, non-passive, so like investment income. So you have all these buckets. But what we want to do is we don't want to just have our losses in one particular area. If we have losses, we want to apply that to any income that we have. And so that real estate professional designation, that allows us to apply those passive losses to our ordinary income or our investment income, really kind of whatever we want to. So very important that we get the real estate professional designation for tax purposes. This, you have to keep records. I will put this into kind of the write-offs. If you have to keep track of your write-offs, you have to track what you're doing, what you're spending. So I always say do that at the same time. So when you are out to lunch, for example, and you're buying lunch for somebody that's a potential client, that is a write-off. That meal is a write-off for you. I would say in your phone or in an app, track like the date, what was discussed, the property or the properties, and the time that you spent. I love a calendar app because it's all in there. If you ever get audited, here's my calendar, good to go. Or, use some other app, like there's a lot of pay apps. Yeah. So just keep track of those notes so that we're tracking our expenses at the same time that we're tracking the time that we spend in the real estate. And so as long as we're doing that, we're going to be good. So some of those deductions that we can have, again, the real estate professional is a big piece of that, so that we can have those. There's a number of things as a business owner that you have. Before we hopped on, we discussed like the Augusta rule, which allows you to rent your home for 14 days to the business. There is, you can employ your children. So when you employ your children, you're essentially, you can pay them up to $12,950 because that's the standard, exclusion deduction. So we can pay them $12,950 per child. We need to document the time that's there, and it needs to be a separate account. So if you're just going to write it down and keep track of it in your head or on paper, that's not going to cut it. We have to set up an account for the child or the children, separate accounts. you can be in control of those. They are still your minors. They're your children. You 100% have control over it. I would suggest just setting up a child account at whatever bank you
Like
use.
a custodial account, yeah.
100%. And then you can just transfer that money into it, set up regular deposits, and use your kids for your marketing. Like that's the easiest thing to do. Have file stuff. Like they can get on social media. They can like your posts. They can look to see what's trending. Take videos of them doing stuff. You know, like there's tons of things that your kids can do, and they're going to be involved in your passion. So like anytime we can bring our kids into our passion, that's fantastic. Like we want to, we want them involved, right? So that gives you a chance to get that exclusion. Now you want to use those funds for things for the kids, right? And so one of the big questions I get is, well, can I buy my kids, Gucci loafers with that money? Actually, yeah, you can. I'm not saying you should, but you can buy them clothing because it's school related. You can pay for school functions. There's a lot of things that you can do that are for the benefit of the child that you can use that money for. I will tell you this is, and I want everybody to hear me when I say this, the absolute best thing you can do for that child, and I'm gonna slow down because I want everybody to hear me. The absolute best thing you can do for that child is take 6,000 of those dollars and put it into a Roth IRA for the child. Best thing you can do. So I'm going to repeat that because I want everybody to hear it. Take 6,000 of those dollars and put it into a Roth IRA for the child. That's going to be after tax. Roth IRA is after tax, but it grows tax-free. And when they retire, they can pull that money tax-free. So you have literally set your child up for their retirement, their peace of mind when they're older. You've taken care of that child way later in their life when maybe, unfortunately, you're no longer around. But you have taken care of them. You've done the thing that you should do as a parent. You've taken care of that child. So I love Gucci loafers, all the other nice things, but let's take 6K of that 12,950. Let's put it into a Roth IRA and let's set your kids up for success in the future.
So I want to go back for a second because everything you just said, like people need to rewind and listen to that like several times, but I want to get into it a little bit deeper because this is amazing. Like it's definitely a great strategy. So we're paying our kids. Number one, do we have to put them on payroll or do we pay them almost like a 1099?
Yeah.
So taking taxes out?
No, because they're not going to be taxed. So we have the exclusion. Okay. So I would just do a transfer. If you want to put them on payroll, put them on payroll. It's not a problem if that's easier for you. What we did with ours is we just did a transfer. So we just had scheduled bank transfers that would go into that account. Anything that we needed to pay for, school related, anything like that, we would take it out from that. When we set up the Roth IRA, we took the 6K, we would transfer it out of their account. Think of it as you are controlling the money, but it's not your money, right? So, we're doing what's best for our child, but it's not our money. Like once we've transferred it, it's their money. We're just making the best decision for them. So payroll is fine, but you don't have to because you have the exclusion. So if you are going to do the taxes, they're going to get those taxes back at the end of the year, but we're going to lose some in that process. So I highly suggest you just pay them the $1,250. End of the year, take the exclusion, move on. If you do end up paying them more than the $12,950, if it just works out that way, you're only paying tax on the difference. So if you accidentally pay them $13,950, you're only going to pay at that tax bracket, you're at 10%. So on that $1,000, you're going to pay $100 in tax. So not worth putting them on payroll, in my opinion.
So in regards to the Roth, can you move the 6 all at once? Do you do it throughout the year? Yeah.
Yeah, you can move it all at once. If you want to do it, progressively, you can. I like paying them kind of at the beginning of the year so that we have a full year of gains to gain, right? So it's $6,000 a year, but if it doesn't matter if you do it on January 1 or 12/31. If you do it on 12/31, let's priority that because it takes a while to get these things set up if it's the first time. But I like paying into the beginning. So I'll go ahead and advance the $6,000 on January 1 so that I can go ahead and transfer it to the Roth IRA and I can see that appreciation. Because we all know compounding interest is it's gangbusters, right? It's everything. And so we've seen that with homes, and you can invest the Roth IRA anything you want. So if you have a property that you want to purchase for your child and they have the money in their Roth IRA to make that happen, you can use that. Like the Roth IRA is directed by you. You can use it for whatever you want to invest in. So I love the idea of buying a long holding real estate, income producing property that we can reinvest those rentals, everything else in that property, because that property is going to continue to go up in value. And if we need to sell it, we can. In fact, we can still take advantage of the exchange, right? So if we get to the point where like, hey, we want to increase our property, or we want to sell this single family home, we want to buy a quadplex. You can do that, and we just need to make sure that we follow the exclusion rules, for that exchange. So,
right. You're talking about a 1031 exchange.
Yes. Yeah. 1031 exchange. Again, there's timelines like, I would have something designated because we don't want to go over the timeline and then we get stuck and now we're going to get taxed within the Roth IRA. That can be bad. So I would say in a Roth IRA, it's even more important to make sure that we have something lined up ahead of time, so that we don't end up in a taxable situation, because that would be the one time that we would end up in a taxable situation, with the sale of that, because it's pre-retirement, right? So we don't want to do that. We want to grow that as much as we can within that time frame prior to the retirement when we get the tax exempt status.
Got it. So in terms of, paying your children, putting money in the IRA, all of that is amazing. In terms of things that you can use the money for with them, what are some of the things? Like, can we pay for their private school, or is it really?
Yeah, okay. You can pay for private school. You can pay for uniforms. You can pay for clothing if they don't have uniforms. You can pay for, music lessons, athletics. Anything that benefits the child is going to be included in that. So, it's pretty wide open on what you can spend on. It's their money, you're just helping them direct it. So just don't spend it on yourself, right? Like, and I know nobody would do that, but like, just be very careful. Well, I say nobody would, maybe somebody might.
A few.
Yeah. Like, well, baby wanted a diamond ring. What are you going to do? Like,
baby wanted a Rolex.
Yeah, baby wanted a Rolex. So.
Okay, so all of that is just like mind blown, because a lot of people don't realize that, right? So they don't realize all of the different tax strategies that you can use to get your taxable income down. So what are some other out of the box strategies? And I know that, we talked about in the beginning, the Augusta rule and seeing it all over. I just did a class. I taught like a 2-hour class for an office, and a lot of people haven't even heard of ChatGPT. So I can guarantee you 100%, a lot of people have not heard of the Augusta rule. So if you want to brush, let everybody know a little bit about how that works, that would be amazing.
Yeah, so it's pretty simple. It just allows you to write off 14 days. So you want to do market research to make sure that you're not charging too high or honestly too low. So best thing to do is, Airbnb, Verbo, any of these that, that everybody's familiar with, and see kind of what things are renting for. I personally like to look at peak season. So if you're in an area that has a rental season, for example, that we know that the prices go up, it is completely fine to look at those numbers. So, look at where you're at, look at where the rental takes place. And I would say get the best, rates you possibly can within reason, because you may have to justify this reasoning. But find that. You essentially rent that to the business. The business pays you, and it gets a write-off for that time frame. That they are renting. The home for these meetings or whatever. And it doesn't have to be 14 days straight. In fact, I would highly suggest not to do 14 days straight. Break that up. You can do, maybe a weekend meeting or some kind of team building conference. You can bring people over, have these meetings. So, the rule is like it has to be actually used. So, I'll leave that, up to the listener about how they designate that it was actually used. But that would be the rule. But, again, 14 days, normal rate, rent that, you get that as a tax deduction. So it's a good strategy to use.
So do you have to be an LLC in order to take advantage of that?
You do, yeah. So it has to be a business to be able to take advantage of that, because the business is renting your personal residency, right? So you can't rent from yourself. That would make sense. So you do need to be in an LLC, and so almost every real estate agent is a 1099 contractor. They're getting paid that way. I don't think there's really any W-2s anymore.
Yeah, so according to the National Association of Realtors, only 13% of all realtors nationwide are W-2 employees. So the rest of them are acting as 1099. And so all of those should be LLCs if they're serious about their career at all. And which, of course, we know sometimes there are some that are doing it more as a hobby and they may not want to do that. But an LLC really, it varies from state to state, the cost of creating one, but it's usually only like 150 to 300. About 300 is usually the most expensive that I've seen in any state, which I believe was Texas, if I remember correctly. So it's not, it's not unreasonable to create that, and it's not hard to create one online.
Yeah,
exactly.
So yeah, so most people are that contractor status, so that allows you to do the 1099. If they are paying you in your personal name, then we would prefer that change to your business name. And most agencies, brokers, whatever, they're going to allow you to do this. If you have somebody that is just refusing to do that, they say, no, we're writing you the check. It has to go in your personal name. That's okay. It's not that big a deal. What we want to do is we want to assign that check to the business.
Okay.
So yeah, so don't cash it. Don't put it in your personal account and then transfer it. What you want to do is you want to assign that check to your business. A great way around this is if you know that you have somebody that's the issue, just set up your LLC with your name. So you're Sarah B. Mosier LLC, so when they do write it to Sarah B. Mosier, you take it to the bank and you put it in your LLC bank account, no problem, right? But we do want to assign that. You want to document that. Documentation's everything. Again, with the Augusta rule that we just talked about, document it. You want to do minutes. You want to show that what you met about, things of that nature. So always over document. And again, calendar app, great place to put it. Write some notes in there, good to go. It's saved forever. So make sure that you're documenting this process, but we do need to assign the income to the LLC so that we do have the write-offs for it. And that's your meals, your vehicle. You can take advantage of the 179. You get an 80% write-off this year, or you can, do it over time. So you have your vehicle, you get the home office exclusion. So we can write off the home office, any repairs, we can write those things off.
Repairs to the home.
Yeah, repairs to the home. So
does that count for somebody's personal? I didn't think it counted for a real estate agent's personal residence.
Yeah, so it's in the home office exclusion. So we're going to take a piece of it. So there's two ways to write that off. There's the percentage. So you take the total cost, and then it's based off of the square footage that you use for it. So you want to keep track of all of those repairs, everything that goes into that home. You want to keep track of that because that's the total cost of ownership. And then we're going to base that. So if you've got, 1,000 square foot, home and your home office is 200, obviously do the math. 1/5 of that is the home office exclusion that we get to write off. So we want to make sure that we're tracking full cost of the property. And so you can do that with the home office exclusion. Again, like all the things that you do within your capacity as a real estate agent in the business is going to be write off. Your signs, like your networking events, any of these things, your software, like a lot of people have software, they're tracking their marketing, their CRM, so we just want to make sure we're tracking all of this stuff. And so again, I'm not everybody's CPA that's on here. So I'm talking very generically, I would definitely talk to a CPA about these things. I'm not giving CPA advice as your CPA. But I love when they bring me as much as they possibly can, because it's way easier for me to go through that and say, hey, this is probably something we should exclude. Hey, this is obviously a personal expense. Let's take that off. But if you give me whatever it is that you give me, and there's things that we missed, I don't know your life. So it's going to be very difficult for me to say, hey, well, what about this? Or, hey, do you remember doing this or spending this money? Or, hey, your marketing looks light for being a real estate agent. Did you include your sign? Did you include that, membership into, whatever, BNI or whatever? So like all these things, they count. So provide your CPA with as much information as you can, because they will exclude the things to keep you safe. But give them more than what you think so that they can exclude things. If you go to your CPA, you give them all your stuff, and they don't say, hey, we should not do this, or hey, this looks personal, I'm not going to include this, you're probably not giving as much information as you should.
Right. So let's talk about tracking, because this is a lot of tracking here. And I know people are not that organized. So do you have, aside from the calendar, which is a great point, by the way, any other like tracking apps that people should use to kind of keep track and control of all of this stuff?
Yeah.
I would say first and foremost would be your credit card. Keep a, obviously have a separate credit card, and everything that you think is a business expense, track it that way. And then you can put it on, you can import it into a spreadsheet, and then you can take out the percentages that apply and create rules within your spreadsheet. So that way, if it is a 20% deduction, that it automatically puts that in there. So I would shy away from making it more complicated than it needs to be. Put everything, don't buy things with cash. Don't buy things with a check card. Don't commingle your accounts. Have one account that you use literally for everything. And we always recommend a credit card over a check card, just for security purposes. Because obviously, like if your money gets removed from your checking account, you may get it back, but it may take a few days, which could be a disruption of business, which we're always trying to avoid.
Right. Yeah, I think that's to have personal credit card, all of your personal expenses goes on this, business credit card, all of your business expenses, go on that, and just keep it separate that way. Let's talk about travel, because I love to travel all the time. And one of the things, which I don't know if it's legal or not, is I would make it a point, like for example, when we were in Italy, to go into like the Engel and Volker's office and like take pictures of me there and talk to the agents and and then classify it as a write-off. Is that something that you can do? And what are some ways with travel that you can write certain things off?
Yeah, so I like to tell people to always try to essentially bookmark it around a weekend. So the weekend days don't count towards the days that you're doing business. So if you fly in on a Thursday and you have some business on a Thursday, you have some business on a Friday, Saturday and Sunday are fine to not do business. And then I would wrap up some business on Monday or Tuesday. So it needs to be majority of the time is business related. So I love what you said. I take pictures with the agents. I take pictures of this, take pictures of that. That documentation process is everything. So make sure that it has some real business connection, some business value, right? If you let's say that you are a buyer's agent and you specialize in one city, and that you do not go outside of that, you don't do any referrals or anything like that, that would be an issue, because you can't say, well, I was there looking for properties, for buyers. Well, like if you don't specialize, you never, that's not going to work.
And not licensed in that area.
Yeah, you're not licensed in that area. But if you were to say, we went here because I'm looking for new marketing techniques or more marketing strategies, and they're doing something that's not done in my area that I know I can bring back to my area and have a competitive advantage, that's believable, right? Like, if that's your purpose, and again, like make sure you have purpose. I'm not telling you to lie or make stuff up, but as long as that is your purpose, that's what you're trying to do, is better yourself, better your business, then you're going to be okay. But documentation is everything. Don't wait until you're audited or you get an inquiry and then be like, oh, well, I was there just checking out the vibe, like, So, it's very important to document it. It's very important to have, it has to be majority of that time. So if you have the option of a Monday to Friday, you're gonna have to do a lot of business on Monday through Friday. So if you can make that, say, a Wednesday to Tuesday, now you get 2 free days that you get to enjoy yourself, and you don't have to be 24 hours working. It's a work day, so your afternoons, your evenings, those are yours. So just make sure that you're doing like actual work activity while you're there. I will say this because I've actually had this question and it was funny to me. Zooming back home and handling things at the home office while you're on vacation, not really going to count. So like, we want to do something where we're at, so we justify the travel.
Got it. So, and actually that's why a lot of what we're talking about, first of all, can, you know, really change the tax, you know, the amount of taxes people have to pay, but it's all about documentation. And so with us being right now, you know, in August, now is a great time to get your systems in place and figure out exactly, you know, the different types of things that you can do for the rest of the year. And then once you change it and once you start doing, then you're going to be doing that, you know, year after year after year. And I think a lot of real estate agents, they just don't know what's available to them, and they don't ever think about their business like a business. And if they're crushing it, they're super busy. So to like, you know, implement that at that time, it's so much better to implement it now, you know, when it's a slower time. Any other things that we didn't touch upon that you want to mention? Maybe some like common or uncommon tax write-offs?
I have some. I made a list of some things that people sometimes overlook, so hopefully this will be helpful. Obviously, you know, your continuing education is included, but sometimes people don't realize that coaching is also included. So if you have a real estate mentor and you pay to work with them, that is a write-off. Also, another educational expense that people aren't aware of is the American Opportunity Credit. And then you can deduct $2,500 a year per household member who is receiving undergraduate education. So that could be yourself, a spouse, or a child. And that includes tuition and books and things like that go into that education. So that's a great credit, because a lot of times, you know, you're kind of doing more than one thing. You could be getting a business degree while you're working as a real estate agent. Another thing is like your overseas executive assistant, or your marketing person, the person who edits your podcasts, are things, as long as you have the proper documentation and tax forms, and you have to make sure that the country that you are hiring the worker from is a company or a country that we have a relationship with, because there are some countries that are blacklisted. So you want to make sure that we do allow that in the United States. And then one more thing that I think people overlook a lot is professional services. So if you are paying attorneys and CPAs for your business purposes, those would be tax deductible as well.
Yeah, those are great points. I want to add to the overseas contractor. Like that was amazing. She crushed it there. But with that, as a CPA, like I have to include this. So make sure that you're getting the proper form. So that's a W-8 BEN, so W-8 BEN, and that form you're not required to prove anything. Okay. If you have that form, they are saying I'm, you know, not excluded. I am a foreign contractor. Like I do qualify. So get that form from them. Or if you're working through a service, make sure that the service has that, and you're paying a U.S. company. If you're doing through the service, make sure you're paying a U.S. company for that. If you're paying a foreign company, you 100% need to get that W-8 BEN on file for yourself, just in case you are audited. But that was amazing. I love that. So many people are using that. You mentioned Chat GP earlier. Or Chat GPT. There's all these amazing things that are out there, and so many people are going the virtual assistant route because they can scrub leads. They can do a lot for you for a very reasonable price. One of the things I will say about the VAs is a lot of people say, well, you know, I couldn't pay somebody, you know, so low a wage. The wage that you are paying them in their country is significant compared to ours. So I don't want anybody to feel bad. They're like, well, I can't imagine paying somebody $5-6 an hour. Like, you know, they should be getting blah, blah, blah. That $5-6 an hour is significantly better than the equivalent here. So don't feel bad. You're giving them a job. You're giving them something to raise their family, take care of the people that are around them. And I think that's fantastic. So, you know, highly, highly suggest that. A great point. I'm glad she brought that up. I think that's huge. A couple other things real quick. The pass-through exemption allows you to write off 20% of your QBI. So I can go into that. That's, just allows you your qualified business income. You can write 20% of that off. So that's a good one. Gives you a nice little break. Cost segregation. If you're investing in real estate, the cost segregation study is everything. You have to be a real estate professional for this one to work. So make sure you qualify as a real estate professional, but you can take massive depreciation in that, because instead of being like the 17 and a half or the 25 years, we get to write off all of the pieces of that investment, that real estate investment. We get to write those off very quickly. And so as long as you're a real estate professional, that is written off against your ordinary income as well. So it doesn't have the passive restrictions that it would have if you were not a real estate professional. So that's another great one that I would want to include.
Absolutely.
That's awesome. Real quick, going back to the VAs, and I actually, in the class I just did, I said the same exact thing to them about VAs. I've been using this girl, Jeanette, from Upwork, that used to be called something else a long time ago, but since 2013. I mean, she has been with me for that long. Wow. And she's $5.50 an hour. She got a raise. She used to be $3. But she's happy. She's super happy. That's a good wage for where she lives. But when it comes to tax write-offs, or, being able to, I pay through Upwork, or if someone is using Fiverr, right? So I know a ton of people using Fiverr. How do you have to document that? Do you know?
So as long as it's a U.S. based company, you're paying a U.S. Based company for that, you're fine. If you have questions, I would request that W-8 bin.
Okay.
I believe Upwork, I believe most of those, they have a U.S. division. So I think if you're clean, I can look into that.
That's a U.S. based company, I believe.
Yeah, as long as it's U.S. based company, or they have an arm in the U.S. that takes those payments, you're fine, because that's the U.S. Because you're not paying the person, you're actually paying Upwork, which is a company. So you're going to be clean there. I would just say Google it. That's the answer to a lot of things. Google it, make sure that you're clean. And if you're not sure, say, hey, I'd like to, get a copy of the W-8 bin, and as long as you have that, you're going to be fine.
The way that people take advantage of that situation is that they say that they're an offshore worker when they're actually required to pay U.S. taxes because they are actually a citizen. But if they fill out that form and they are dishonest on the form, that's on them versus it being on you because you didn't even bother to get the form. Right. But if you're paying through a U.S. based company, more than likely you're okay.
Yeah.
Okay. Awesome. Well, thank you guys so much. This was
Absolutely.
so informative. Honestly, the most informative podcast I have done year to date. I've had a lot of amazing people on there, but saving money on taxes is definitely, huge, especially since my kids are going to be going to college in a couple of years. And I think they're going to be looking at that. I got to, reduce some liability over here. But I really appreciate it. You guys were awesome. I know a lot of people don't know about the Augusta strategy. A lot of people didn't know about paying their kids and putting the money in the Roth IRA and what they can use that money for, paying virtual assistants and all of that. So this was huge. Seriously, one of the most informative podcasts that I've ever done, and it was awesome. So thank you guys both so much for being on. Any last things you want to say, or?
No, thank you for having us. It was a great time. This is actually our first time doing a podcast together. So thank you. It was fun.
You guys have to do it together all the time now. It was awesome.
Absolutely.
Yeah. No, it was good. We had a great time. Thank you so much for having us. I do need to give the little legal disclaimer real fast because I am a CPA. None of this is tax advice. Please refer to your CPA or your tax professional to get their insight. But that being said, if you have quick questions or anything else that you just kind of want some clarity or anything like that, am I okay to throw out our website?
100%. Okay? Yep.
If you have any questions or anything that you want to get clarification on, reach out to us on the social medias, or you can hit us on the website, CFOAF.com. So Chief Financial Officer, CFOAF.com. It means what you think. Hit us up. We're happy to talk.
You.
Yeah, it's exactly. Always happy to talk strategy. And one of the things Krissy said earlier, I wanted to repeat is we don't do just tax prep or tax files. We do tax strategy. The reason we do that is because when we do tax strategy, the money that you have to pay in your taxes, we're going to make sure that it's a net win for you. So if you're just paying somebody to do your taxes, you give them all your stuff, you give them a bunch of money, and then they give you a bill from the US government. What we do is the money that you pay for tax strategy, we find that plus more to save you money. So it's very important to us. It's a point of pride for us that the money that you pay us is going to come back to you in the form of those tax savings and all the things that we can do for you. And that's why we don't do just tax prep. We do strategy with the submittals.
Honestly, you need both. Like there's a lot of people that just pay their CPA. I know my husband complains all the time, like we need a new CPA, like that, we're not getting the actual write-off. So I will be calling you. But everybody, don't forget to like and subscribe to my YouTube channel. And this was great. Thank you guys so much. I had a ton of great value. So I really appreciate it.
Thanks, Danielle.
Thanks, Danielle. Appreciate it.
Bye, guys.
Bye-bye.
Well, that's a wrap. I hope you enjoyed today's episode of Real Estate Secrets Unlocked. Don't forget to subscribe to our show on your favorite platform, and we would love your feedback. Check us out on social and let me know what topics you want more of. Don't forget to like and subscribe to our channel and our show. I'm your host, Danielle Damianov, and until next time, stay motivated, stay excited, and keep growing in this crazy world of real estate. Thanks for listening to Real Estate Secrets Unlocked.